Fantastic. Hi, yeah. So I'm Alastair, as said. You've seen a lot of me today. I'm going to see a little bit more now. We've been talking a lot at kind of a high level so far, but we actually want to kind of get in now into some of the weeds, so to speak. And we're going to be talking about sort of the professionalization of digital assets, digital asset markets, what that might look like, and the market structure around that. So I'd like to introduce my panel, and then I'm going to start with a polling question because I've been enjoying those so far. So on to my immediate left, I have Adam Grimsley, who's the co-founder and head of investment solutions at Prime Factor Capital, a crypto hedge fund. And to my next left is Elizabeth Rossiello, who's the founder and CEO at BitPesa. And to her left is Julien Auchecorne, who's the chief operating officer of XBTO International. So I said I'm going to start with a polling question. If you wouldn't mind indulging me one last time. The question is this. What will be the most important contributor to a robust and grown-up market for digital assets? Interested in your thoughts. We have futures, options, lending, electronic trading systems, more tools for shorting, and an ETF. Okay, so no one wants to go short in this room. Okay, seems ETF wins. Might be waiting for a while for that one, but we can discuss that on the panel. So I hope we can have a free and open discussion, but let me go one by one and ask you to answer the same question. Adam, how would you respond to that?
Yeah, I think that's these are all important aspects to a market, but I think they're secondary elements. I still think there's a danger for people in a bit of in this room and the bubble to think that we're reflective of how crypto assets and how Bitcoin is seen globally. I still think there's a huge amount of education is needed. And I think that education comes from experience. I think people don't work and understand things very well by sitting in classrooms. I didn't learn anything at school. It's one of the benefits of the English educational system. You don't really learn anything. But what you do learn is from practical experience. So I think the most important contributor for a robust market is that education, which comes from adoption. I think actually finding some use cases for a lot of things we've been talking about here today. I would put that really as the kind of the ground zero, and I still think we're not there yet. So I think these are important in terms of the investment sphere, but for a robust market, I think understanding and adoption and actually having some kind of level of consciousness just on the normal people is what I'd put as number one.
Okay, Elizabeth, how about you?
Well, I don't mean to cause a ruckus from the start, but
please do.
The words normal people, grown-up people, I mean, who is this group to decide what a grown-up already means? And I think we're quite biased already when we think of what this group in this neighborhood, and I don't see any people of color, maybe two, definitely no African people of color here, very few Asian. I mean, what is China doing? What is Africa doing? I mean, the government of China, the PBOC right now, thinks that this is grown up enough to do a major government project. You see gigantic exchanges start and 6 months later have billions of assets traded weekly, so I think, is that not grown up enough for us? Do we need to have it traded here in the city for it to be grown up? So I think I struggle a little bit with the word grown up, and I'm laughing a little bit because the future is not here. This is no longer the center of the earth. And if we look at the population of the UK, which is 65 million, population of Nigeria, 200 million, guess what's going to grow in the next 10, 20 years? Population of the UK expected to grow by 3 million people. Nigeria, another 200 million. So we have to think about, what are these people using, and are they using these products? And, when I go to developer communities, I just got back from Hong Kong, just got back from Shanghai. What are they working on? Everybody's working on digital assets. Right. So for them, this is not even a question. This question's been answered 3 years ago, 3 years ago. So I think we have to think it's not necessarily futures traded here in the city, but maybe it's futures traded on Huobi or Binance, and what does that look like? And that's already happening. And as Meltem said, just to echo, what is the next generation of spenders and users and savers and traders looking to use? And I think we're already there. We've answered this question.
Okay.
I actually completely agree with what you just said, but getting to the weeds a bit more about this question specifically and to endear myself with the audience, I'm going to say that you guys all flunked. I would argue that futures is actually the most important contributor. And let me break it down. If you think about what the future is basically kind of spot plus cost of carry. The main variable in cost of carry is interest rates. So if you've got a reliable futures curve, suddenly you can actually infer from that as a lender what your risk-free rate would be. So if you've got a reliable futures curve, suddenly the lenders can start thinking about what the benchmark rate should be when it comes to their own lending activities. When you think about options, in most markets today, the underlying isn't actually the spot, but it's actually the future. And in this market, we've observed, actually, there's compelling examples for this year alone, where actually you can have huge distortions in the price of the spot market, which trigger huge liquidations in the derivatives market. With a more robust futures market, you kind of de-risk yourself a little bit from that. And the same applies to shorting, actually, because if you think about it, a lot of the shorting activity takes place by way of actually borrowing assets. So when it comes to electronic trading and ETFs, I think ETFs are important because they will send a strong signal that some of the governance associated to retail access to the market has been sorted out. But I think of it more as a stamp of approval from regulatory bodies than I think of it as a huge step forward. And when it comes to electronic trading systems, I'm not going to lie, I'm not sure what we mean by this. Because all the trading right now is electronic. There is platforms today that are doing a great job amalgamating spot prices and creating actually quite neat solutions for people to, especially retail investors, let's say, to get the best execution possible on some small orders. So I'd say there's been some great progress made in that area already.
Right. Let's talk a little bit about derivatives. That was sort of area that you highlighted, and that's been a kind of a real growth area in the last sort of couple of years in crypto. And I guess I was going to say, interesting your comments, because London has played, and this is not really a panel about London, but I'm just thinking about the derivatives market that we have. We have this kind of many decades now of a well-established market for derivatives. There's a robust legal framework for all this stuff. It's kind of very well established how you trade swaps and whatnot here in London, I guess in other jurisdictions too. But in the kind of the boom of crypto derivatives, I wonder, and a question to you is it as robust? Is it as well organized? I mean, should it look the same? How is this evolving? It's growing very quickly. Everyone is talking about derivatives. Everyone is trying to either trade them or kind of start their own business in this sector. I mean, Adam, perhaps I'll start with you. How do you think of this?
Yeah, again, I think it's a function of where we are with the markets as a whole. I think we got off to kind of bit of a kind of a million miles an hour start with this whole asset class as a whole, and we had a great speculative rush in terms of prices, and now we've kind of just bobbled around a little bit, and people are not exactly sure where we are, what to do with their kind of crypto. If you look on a lot of these kind of sites, they're all saying, look, these derivatives are able to you to have your cake and eat it, so you can earn some money now. And not sell because that crypto that you have now is going to be the money that you're going to buy for your next house in Palm Beach or your Lambo or whatever it is in the future. So it's really kind of responding, I think, a little bit to what the demand we see from those kind of people who've held crypto for a while, and they're trying to think of desperate ways of trying to make some money where their elements are there. And to be fair, people have come into this market because you can make a lot of money from that, from matching these demand and sell. I know we're going to talk about kind of maybe crypto loans a little bit. Some of the large amounts of loan origination is huge. It's pretty big. Like $5 billion and so forth. But actually, the return some of these investors are getting or loaning out is pretty small as well. So I think that's the major thing where we are. But there's a bit of disparity between smoke and mirrors of actually how much people are using these things, how much of success they've been in the market.
There's a lot of rustling and movement on this side. I feel like both of you want to say something.
Yeah, it's exactly what you said, risk and return. So, I started my career covering German-speaking Europe. Not a high-risk group of customer segment, right. Specifically in Switzerland. But is that population what's going to be buying financial products in the next 5 years, 10 years, 20 years? So, I'm almost 40. I'm not a millennial. Sorry, just missed it. But, I'm not a Swiss, billionaire on Lake Lucerne. So the question is, what am I choosing? What's my risk profile? Now, I lived the last 10 years in sub-Saharan Africa, so probably higher than yours. But I mean, what does that look like? And I think we need to think about what is the buying power of this. And there are a lot of extreme Lambo, Palm Beach, to the moon, uneducated crypto investors, but there's also people in the norm that are thinking about using this as instead of going into an ETF or instead of going into something they might have done or pulling their money out of Fidelity, which I did 6 years ago. So I mean, at what time, what is that middle moving looking like? So we can talk about what's happening right now with your portfolio of customers today, and we can talk about what's the next 24 months, the next 5 years look like in terms of risk profile. And I think the risk profile, because of this extreme boom and bust, has kind of Trumpified us. It's like made us immune to insanity, right? And it's like made us a little, ability to absorb a little bit more risk than we might have been willing to before. And I think then that numbs us, just like it's numbed me working in Nigeria. So I think it's interesting to think about that. When I started in banking, and Bloomberg, thank God, took that little photo of me my first day of Bloomberg training off my badge, thanks to GPDR. ETFs were just coming out. We were still thinking about this, so we didn't have this opportunity. Now the barrier to entry has been lowered, and we can't take it back. So that's the exciting point. And I think along with the barrier to entry lowering, you're seeing the risk profile of consumers of these financial products change.
I think you guys are both alluding to the fact that in any market there's nuance, right? You've got buyers, you've got sellers, you've got speculative interest, and if we're going to go into derivatives, you've got the kind of utility of a derivative contract when it comes to managing your risk or expressing a more nuanced view about what you think is actually going to happen to the asset class. And I suppose that where concerns may arise is it just speculation? Is it just basically one prop trader against another prop trader offsetting this risk to a third one? Are we kind of playing this kind of shuffle game of risk within the market? If that was the case, I don't think it would be a massive concern in the first place anyhow, right? Because this is somewhat, those speculative appetites is how this market's going to grow. What we do know is that actually having a healthy derivative market is something that is beneficial to the overall maturing of any given kind of asset class. Historical evidence shows that as derivatives grow as a proportion of overall kind of investments, volatility tends to actually trend down. So I think that we should look at what's happening today as, yes, it may be fueled by speculative interest, but there's use cases there to say that derivative products have got some utility. To your point, if you want to basically hold on to your Bitcoin and you want to kind of sell calls on it because that could generate some yield, why not? This is something that I think investors should have an access to. Right. And similarly, if you're a miner and you're taking a risk on a future production and you want to be able to hedge that production, same thing. It's fantastic that there's now a market that can actually cater to that. And
the buyers have opened up beyond the top 10 clients that you're used to serving.
And exactly. And when you start going to that, suddenly you really expand actually the range of interest and the benefits to the broader population.
But is it skewed now towards the speculator? I mean, I've written about like miners selling covered calls and various things like that. But
the market, but like everyone's kind of alluded to it in the previous panels. Like the market is skewed to the speculator because ultimately this is a venture investment that's trending towards store of value. I think that in your case, I would definitely kind of caveat that with the work that now rebranded Bitpesa, Aza, is doing. That I think that's a different example when we really start talking about access to funding or to kind of providing financial services to the unbanked. Then we're looking at a different kind of corner of the market, which has got its own narrative. But otherwise, it's the nature of the current market's maturity that there's going to be a very high proportion of speculators as the main investor base at this point. And that's normal and that's fine.
Just to interject quickly on this. Yeah. So my company buys and sells currencies, mainly African pairs. Our customers are not the unbanked. Our customers are some of the Fortune 10 companies in the world. And there's a really interesting PwC survey that was done that said when we started out in 2014, over 75% of corporate treasurers of the top 50 companies in the world would never use a digital product, would never work with a fintech, and wouldn't be interested in doing any kind of treasury trading, hedging, or derivative management online. without their traditional banking. 4 years later, just 4 years later, that's now dropped to less than 25% would be unwilling to do that. So now it completely flip-flopped.
Right.
So now we're seeing, the top remittance company, top payment company, top FMCG companies in emerging markets all coming to us, willing to pay us in crypto or willing to use a fintech or a third party. I think that's a wild change in opinion and risk profile.
Okay.
The only one thing as well, I suppose about professionalizations, it allows a kind of a first step. The derivatives market allows for a first step into crypto as a whole, in the terms that you can turn a market which essentially you may like or may not like particularly, but it gives you the opportunity set to turn a market which you think is going to fail or go down or be very volatile into a return generating portfolio. To do that. So a lot of our clients that we've spoken to, they said, listen, we're intrigued by it, we don't really understand it, we like it a little bit, it may be uncorrelated, we don't know, all manner of different opinions on it, right. But we're worried by the volatility on that. So you've seen a lot of rise of kind of hedge funds taking kind of market neutral strategies in this space where they've kind of limit the downside, and obviously kind of the growth of the derivatives markets gives the opportunity, right? Enables that to be able to take the to be long when you want to be long and to be short where you want to be. And some of the new things that we see coming on, so like the options market. I mean, traditional markets have we used to sit, when I worked for BlackRock for many years, they used to sit and say, well, there's no volatility in the market. We can't really do anything because everything's correlated. There's no volatility. There's plenty of volatility in this market. If you like volatility, and one of the ways to express and to express that in a portfolio is by the use of options. That's a traditional way of doing it. So again, we're kind of building up the narrative and the story.
And this enables, I assume, more sophisticated trading strategies, right?
Sure, just by the nature of it being able to take, just not purely.
Where there's volatility, there's complexity. Where there's complexity, there are more strategies, right?
Yeah, so absolutely. But that's again the kind of real volatility strategies was only a small part of the portfolio. When we used to have these big global meetings on the desk, the easiest way to clear the room was to start talking about volatility strategies and the Greeks and so forth. Everyone kind of went, right, I'm out of here. So, I don't understand it, don't want to touch it. So, that's still going to be a step thing. But, it brings other things into the market. It brings innovation, which this whole market's about.
Let's talk about another kind of boom area, and that's lending. It seems like anyone running any kind of crypto business wants to lend today. And anyone who holds any kind of crypto of any kind wants to lend it out, earn some yield on it. I wrote recently a piece. I'd been speaking to a number of fund managers who were expressing kind of concern about how perhaps, obviously, yes, this market is in the grand scale of kind of the credit market's minuscule. It's only about 5 billion, but it's 5 billion.
That wasn't there 2 years ago.
Right, or even 18 months ago, yeah. Right? And there are various people suggesting that some of the lending is getting a bit out of hand. It's getting overheated. Do you see this as a kind of a genuine risk, or this is how are you viewing the crypto credit market?
It's the nature of credit that you
boom and bust.
Boom and bust. So,
right.
Unavoidably, the more the market grows, and like the more the pace of it accelerates, the more that risk becomes prevalent. Having said this, I think if you look at the market today and what the lending looks like, what you do have actually is a lot of companies that have got a lot of potentially client inventory effectively they're sitting on, and then trying to generate a return on that on behalf of their clients. And so that's one of the primary motivations for people to come to the market and act as a lender. I think that the moment you speak about lending, you get into the weeds very quickly. And when I look at those companies, I'm thinking, these are people with potential retail inventory that are now going from just being a custodian to a lender. I see, red flags tend to emerge from every corner.
It's not the same business.
It's not the same business. It's not the same risk. And from a regulator standpoint, I don't want to dive into that, but definitely they would opine that things need to be a bit different as an operation if you're going to do that. So that's one part of it which is understandable, but also potentially concerning. The other part of it is that if you look at the demand side, it's quite an odd market whereby what are people actually borrowing for, and a lot of this I think goes back to what some of the traders are interested in doing. Getting margin, obtaining leverage to kind of maximize their return on their views, and on that front, that's when I think it gets a little occasionally odd, whereby you're going to have a lending business lending to an institutional trader, but the institutional trader would also be getting loans from an exchange, for example, to actually trade on that exchange at the same time. And then you go back to the actual lender who will be telling you, yeah, we're also lending from that exchange. So suddenly you see this kind of like bug being passed around in ways that are a little bit hard to untangle. And when that happens, doubled with the growth of this market, then I guess you got to be a bit mindful. Yeah. But I would also say that the mitigant is this is kind of rarefied air, right? Like the contagion risk around this is basically zero, in my opinion. And the cost of capital is also can be very kind of skewed and fragmented because of the complexity that comes with the on and off ramps into the industry. So getting actually hard dollars into crypto, especially in any meaningful size, is tricky. Getting them out is tricky. Moving your capital around, especially if you want to trade across jurisdictions, can be complex. So there's also it's got its unique characteristics at this point due to its maturity that make us feel like it's okay for now.
Yeah, and there's another aspect of this. That's some parts of the lending. Other parts of lending is, there's a large portfolio that has 137 companies in the space. Another arm of their portfolio, Genesis, which started a lending business, and their lending business, I was one of their first customers, was for working capital. So we're actually creating value with the lending. And why did I take it? Well, I'm not the norm. My business is not the norm. It was really hard to get working capital. Yeah. 3 years later, I just closed a $45 million debt facility from one of the tier 1 bank. So until I was able to access normal people's financial products, I had to access this. And I think that's why I'm here, and that's why I'm such a very loud advocate wherever I go, because this is breaking down barriers. And, even though I did work for a bulge bracket bank and I have an Ivy League degree, I don't look like a normal business operator. And so it was very difficult to access that funding. Yeah. And I think that's super exciting. And I think we have to think beyond. That's one portfolio of 137 companies. One, I think they have $2 billion under management now for their lending product. Right. But I mean, that's just the beginning. We're at the very start of this. Now imagine 50 of those and how that looks like. Now we're changing the working capital, with the operating capital funding structure for a lot of companies around the world. And now you can start to see ecosystems develop that weren't developing before. You can see Singapore, you can see Nigeria, you can see Peru, Mexico City. All of a sudden you can see hubs outside of just that traditional hub. And I think that's very exciting for the space, and we shouldn't just push it to the side.
Yeah, I agree.
Yeah, I think we shouldn't everything to be perfect. I think Elizabeth's correct. These are, it's about that kind of decentralizing finance and so forth. I mean, we've tried that in the UK, kind of open banking. Is slowly getting there.
Slowly.
It's slowly, very, 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 very slowly. I think it tells you a little bit there, right? I mean, that's trying to implement a new technology into terms of the finance world with huge support from, pretty much government, everyone.
Lots of legacy.
And lots of legacy and so forth. And that's moved at a complete snail pace. And most people are going, can't be bothered with it at the moment. I've got other things to worry about. So, we didn't beat ourselves up too much about this.
Having kind of focused on derivatives and then also on lending, these are two kind of areas that have grown rapidly in the last kind of 18 months or so. And in the last 18 months or so, we've seen a real kind of boom and then bust. And then I still think that we're kind of, I don't know if you could, Travis had a nice comment on the first panel. Can you really call this a bear market now? I don't know, but it's certainly not the most buoyant times, perhaps you could say. Do you think these things are, lending and derivatives and things like that, are kind of the building blocks of a more mature, I won't use the word grown up, more mature market for digital assets? Or are they just kind of simply ways of making money, churning out some revenue in the downtime, and when we have the next rally, these will just kind of drop to the side?
The answer is absolutely both, and that should be fine. Like your example is the prime example of why lending is important in this market. The thing that's going to fuel that is the liquidity that's going to come to it, and that's going to be fueled by speculative interest. So it's both things should be able to coexist and should be encouraged to do so. The kind of market, the booms and busts you're going to see as part of that process, in my opinion, are going to be linked as much at this juncture as to the kind of the market structure and maybe some of the pockets of risk that may kind of overinflate, as it is about the kind of underlying trying to find its feet and maturing as an industry in the first place. But otherwise, yes, we need this market. We need the market in derivatives and lending to grow, and we need to get comfortable with the risks that come with it.
And speculation isn't a dirty word. everybody here made their money speculating, So I think we have to think about, pure speculation or speculation and building. We need to see the variation. So in down and up and cycles, you're going to see builders, you're going to see investment, you're going to see more complex products come out. Those are great. Nobody wants 1,000 crypto companies that are just buying Amazon points and reselling them for crypto. Everybody wants variety in their financial sectors, and so that's a great thing.
Okay. With time running out, one question I really wanted to ask you was, okay, we've been talking about derivatives and lending and things like this, which exist in traditional markets and being kind of ported over and kind of developed for digital assets. But are there kind of business models, products, etc., that only can exist in a tokenized blockchain-based universe? I mean, I've recently been writing and paying attention to this movement called DeFi, decentralized finance. And it's small and experimental, but some very interesting stuff in there. You've got like ICOs and STOs, which could in theory be kind of early stage fundraising tools. I mean, let's talk about how those kind of things might play into the market structure of digital assets.
Well, think about crowdfunding. Crowdfunding was impossible before social networks and the internet.
Right.
And then that came up. We would never, in the 80s, imagine trying to describe that to somebody, and now look, it's old hat. So I think we have to think forward how possible that is. And I think already we've seen, when I try to connect to a tier 1 UK bank on their open banking platform, I want to jump off a cliff.
Yeah.
When I connect to a Singapore-based crypto native company, and we're not even trading crypto, they're just crypto native, but our systems connect, it's like, angels singing, So
right.
I think we have to think about just the ease, and it is legacy. It's much harder for Santander to get rid of everything it says and start something totally new. They're carrying so much baggage. So the speed of innovation, there's a reason why Facebook and their millennial employees were able to move so fast, and why WeChat is moving even faster. It's the speed of innovation, it's the lack of legacy. So I think you're going to see a lot of innovation happen there.
I think that also echoes some of the kind of comments that I made earlier, by the way, which is when it comes to DeFi, there's this kind of uncomfortable truth in the market today, which is everyone's kind of invested, extolling the virtue of the decentralized networks, but at the same time, actually a lot of the trading is kind of migrating towards centralized venues. You're trading on an exchange, so you have to kind of get comfortable with that implicit contradiction, or you've got to get excited about people that are going to then build this extra layer of governance or infrastructure that is actually in line with what the core values of the space is about, i.e. decentralization. So for DeFi, finance, I think that therefore it is super exciting. But if you think that there's scalability kind of issues with Bitcoin today, and then you put DeFi on top of this, then you've got a real kind of scaling hill to climb. Right. When it comes to kind of STOs and ICOs, and we're still, I think, dancing on the ashes of that market at this point. But
bad couple of first ambassadors.
Possibly, and at the same time, I feel like it's a stark reminder of the fact that some of the most ambitious projects in it were people that were, let's call it, kind of trying to democratize kind of value creation, right? And so Milton alluded to it. We've got this huge malaise at the moment with kind of FANG dominance in this market. We've got people that are basically presenting investment opportunities to actually say, we're going to redistribute value creation, not just to the company, but actually what about to the person who actually volunteers as data to the platform? How about that? And so some of those projects were destined to actually deliver on that as well. And I think that that's something we should remind ourselves of, because it's where a lot of the real innovation is going to come from.
Yeah, I think there's so many factors which tap into this, and we've covered them in terms of just the cyclical nature of private equity and so forth, where that skews in terms of the term sheet, who has the control of that, the feeling of frustration and of just the way the world is working, of the world, rich people get richer and richer, and central banks' policies has increased that, and the real opportunities are not accessible to a huge amount of the people. People said, Bitcoin, these returns are unheard of and things like that. Those are returns which you can get from VC capital, from projects, that have happened many times in the past, and things like Uber and so forth like that. So, that's why this space is so exciting, because there is this huge speculation. There are these things, and it goes back to the things about the loaning businesses. I think we've become, and Elizabeth talked about this a little bit, we've been kind of immured from failure. failure and destruction of companies and so forth is a hugely great thing. Speculation, they should fail. They should fail, and we should pick up the diamonds of the, from the wreckage and use those as things that actually worked and go forward. All companies shouldn't survive, and central bank policy have created this zombie-like element. So, I mean, that's a bit of a rambling answer to a question that it's everything really in a world. But it's going to be exciting times thing, and I think regulators, the role in this as well is. I think they've done quite well a little bit. If you look at the FCA's, the first line of it, I'm going to get it slightly wrong, but it says the first half is to protect the financial industry. The second part is to encourage innovation. That's then their fundamental.
That's the part I quote.
Yeah, exactly. So I suppose you try to forget the first part and concentrate on. But
I'm licensed by the FCA, but yes.
But it's there, and as this is, they're doing a good job, I think, of that. So the future hasn't been written, and it's in there's some great projects coming forward.
Fantastic. This panel, like the others, we could keep going. I have other questions, but I'm afraid we have to stop it there. Thank you very much, my panelists, Adam, Elizabeth, and Julian.
Thank you.